Welcome to the Real Estate Show on KMED. Saturday, September the 23rd is our date. Pete Belcastro and Joe Brett, the real estate guys, with you here today on KMED. We're both real estate brokers with John L. Scott in Southern Oregon, and we get together with you once a week here on KMED to talk about all sorts of real estate-related issues and topics through, well, this is number 403 today here of all those shows. We're almost 9 years worth here.
That's pretty good, you know. If you had 403 wins as a major league pitcher,
pretty good,
you can reserve your place in the Hall of Fame.
That's true, really true, isn't it? I didn't think about that. Anyway, today on the show, Giles is standing by. Guy, of course, is our resident mortgage expert from Bank 34. Guy Giles, nice to see you. How you doing?
Oh man, I'm good.
Well, here, look at this. It's fall already. I mean, look at this.
It's like it happened in one day. I mean, literally. I'm getting ready to move, and I was moving stuff in the backyard last night, and I could see my breath, and it was just the craziest thing. It was over as quickly.
Wait, and you hit that hint of fall, so we'll see what happens. And,
getting ready to move. I'm busy next weekend. Sorry. Dang it.
Oh yeah, you're such a nice guy. I won't mention how good the Ducks are doing and how.
Yeah, all that good stuff is going on. Anyway, well, welcome to the show.
Well, I'm really not going to help you move.
Nice to have you here today. So let's talk about interest rates for just a minute, kind of bring folks up to date on what's going on. What are you offering? What are you kind of telling folks this week about the interest rates on those? Start with conventionals and on and work our way down.
Yeah, well, with the conventionals, I always try to get people towards conventional loans if I can. I mean, if you're getting a VA loan, that's really good. There's definitely a place for USDA and FHA. I don't like giving mortgage insurance for the rest of your life or forcing you to refinance and spend a lot of money to do that.
Which is what FHA loans are doing, correct?
Yep.
Now, just stop there for a second. They have continued the mortgage insurance through the life of the loan, correct?
Yeah, it was.
Are they going to change that? Have you heard anything about that?
I haven't heard them doing that. It's I think like anything, once you start seeing that money, it was initially intended to kind of shore up the FHA after the whole crash. But now they got that money now. They have their little niche market, and the only thing that I can see is if Fannie Mae just really Freddie Mac start really taking a big piece of that market share, then they might have to redo it at some point.
But listen to what you just said. I'm steering more people towards conventional loans, and that's maybe
a horrible word, by the way.
That's true in a real estate show. But I mean, that's a more viable option, oftentimes financially for your clients, and maybe that, I don't know, over time, maybe the feds will see the folly in that lifelong mortgage insurance. Well, they're driving clients away. If you've got other options, why would you lock yourself into that?
That's generally when you see them loosen something up. It's unfortunately not out of the goodness of people's heart. They usually spend other people's money out of the goodness of their heart.
What it's done is added a lot of cost over time to people who are borrowing. I mean, that's the problem with this thing. And,
I mean, it does definitely fill a niche. I had a gal today that's a really nice lady that had a foreclosure 4 years ago, so she's not quite ready for traditional financing. So there's definitely a place for it. And this fund that I'm going to talk about a little bit later, that is an FHA product. So they do a few things, right, and it's getting a lot of people into a house a little earlier in the game than they might normally be able to. So it's good.
And speaking of buyers, do you know that according to the National Association of Realtors, there's over 6 million people over the next few years now will become back eligible for loans who had foreclosures and bankruptcies in the previous 7 years.
Short sales?
I think go back 7 years, 2010. Those people, 6
that was
million
prime
people.
Time too for that activity. Yeah, that's when we were
6 million people are going to be coming out and will be eligible. They can now come and get a loan again. That's a huge, again, backlog of buyers we talk about. That is coming onto the market now, beginning it began this year.
So 944-6987, I guess, would be my phone number. So that's how I'd mainly react to that.
Yeah.
But there's a lot of really good people out there. I mean, bad things happen to good people, and there was. Everything from the anesthesiologist to the garbage guy.
Yeah,
a lot of bad things happen to a lot of good people during that time.
Yeah, and even Fannie Mae and Freddie Mac, they couldn't keep their doors open, so your tax dollars got to bail them out. There used to be a huge stigma against, hey, you had a bankruptcy, you had a foreclosure. There's a lot of outside factors that cause that, and then the guys and gals that get to write the rules for this stuff couldn't keep their books, so we had to bail them out, and it's like I said, there's a bunch of good people that'll be ready to buy.
Right. Rates now.
Smarter and
what
savvy.
what are you giving rates now these days?
Well, they're kind of like gas prices, They're just up one week and then down the next week and up one week. We had some jobless claims came out, was the very latest data, and less people claimed, jobless. I can't think right now. But anyway, a lot of that had to do with the hurricanes, though. There's a lot of work. People are able to find work.
Right.
Unfortunately, we're obviously praying for those guys down there, but that has a lot to do with it. In the old days, something like this North Korea thing would have had a big effect on our rates, and it's almost like people are over it. It's just white noise at this point.
I think because we see it all the time, it berates us every day. 24 hours a day, you become immune to it. So you just go on with your life.
You had another threat to America.
You can't do much about it,
world,
so you continue to go. Okay, rates, what do you got? Okay,
we're still in the mid-high threes on the government stuff, and we're in the low to down to 4% ish on the conventional. So they're really good. And like we were talking about earlier, there's definitely a niche for the FHA buyers. But if you can get if your income's not too high and you can get 3% from a parent or, somebody as a gift, we try to get you into a conventional loan. Definitely not talking about, we talked about that before the show, co-signing for somebody. That's a whole other story.
That's a whole other story.
I'm not a big proponent of that. But if you can, give your kiddos a little bit of money for a down payment and then they can get into something conventional, it's just a good way because that mortgage insurance is forever on some of those,
because it's actually
all of those.
More lenient on gifts from your parents, gifts from somebody to help you along, where it used to penalize you in some of those cases.
They really did, and I think that was one way that the Fannie Mae and Freddie Mac kind of fought back the FHA and took back a little bit of that market share because they were a little bit stricter on what kind of gifts you could receive and how much you could do, and now it seems they're the ones that are a little bit. Well, actually, both of them. I mean, gift funds are super easy on the FHA too. So,
gift funds, you got to have them sometimes, but for parents, you're better off to give your kids money for a down payment, pay their closing costs, rather than co-sign the note. Yep. Remember that, right?
Horses.
Or
that was my mistake.
Let me tell you the story. Anyway, so but that makes a lot of sense to do it that way if you want to. In a better way.
Yeah.
Do you see that? Do you see that a lot?
I am seeing a lot of family members pitch in and give a little bit of a gift. And I had a doctor one time that just got out of med school, and he literally had so many student loans, something we'll talk about a little bit later, that he couldn't apply or he couldn't approve for a loan. And he said, I don't want to talk to my parents. And I said, look, would you do it for your kids? And he said, all day long. And I said, well, just put the roles reversed. It might be a real blessing for your family to help you get into a house. And he did, and it worked out for him. And the gift funds are a good tool to have.
That was good counsel.
Yeah. Well, we'll see what goes on.
Would you do that for your own kids? Yeah.
Not me, but his kids. No, I'm kidding.
Because you can't, because you got too many horses.
Oh my goodness.
What's happening on the government loans? The USDA, the rural development loans. Do you see many of those? We used to talk about. One time they dominated this market almost
outside the city limits. Yeah.
But I don't hear about much. I don't even hear buyers don't even talk about them anymore. So tell me what's going on with them.
It's probably a much more prevalent product in Klamath Falls or at the coast or some places that people aren't just priced out. I had one on this Genoa fund, another thing I want to touch on a little bit later. That's this other 100% financing option I have. And these people really wanted to go USDA, and I really wanted to put them in that product. But the husband was getting a little bit of overtime. So when we finally got all of their documentation together, he made too much money, so they couldn't do that program. And it's a great program if you fit into that niche, but if you're getting and
the niche is
it's for lower income people is what it really amounts to.
Well, it's income qualified. Income qualified of about $80,000.
That's the funny thing, though.
It's pretty high.
Even at that, you can barely qualify for a house these days unless you have no debt at all. So I don't mean to say low income. I'd have killed for $75,000 years ago.
Yeah.
But it's just. If it fits a niche,
but you just don't see many of them anymore like you used to.
I probably haven't done one in 2 years.
It's got to be partly in part due to the rural properties that were available or were out there. It just got so high priced.
It's
in the green rush and some things we've seen with rural properties, and probably not that many just coming available.
And the funniest part about it is being a rural property. You think USDA, if there are any outbuildings or anything on that property, they take that right out of the appraised value. So you can get burned on that too. And I mean, it's a great program. And if our property values were a little bit less, I would sell it all day long. The mortgage insurance is cheaper than it is on the FHA, and it's 100% financing.
You almost have to make more than the USDA threshold to be able to afford a rural property.
That's the problem.
Right.
Yeah,
36% of new buyers, of all buyers, are first-time home buyers, according to the NAR. Again, 36%. That's I thought was high.
Wow,
surprised me.
But that's people have been out for 3 years.
Right. You haven't. A first-time home buyer. Remember, if you haven't owned a property for 3 years, you qualify as a first-time home buyer. That has some advantages to it. Are there any? Does it matter in loans anymore?
Some of those folks coming back in those numbers.
Well, that's the funny thing about like this 3% down, like the Home Ready programs. Both Freddie and Fannie have their own version where you can have 3% down. Again, it's if you're 115% above the median income, then you can't really fit into that bucket. But it's I don't even know. There's
just all sorts of different loans, different types of things that are out there. So that's always that. Well, one of the things you talk about is 100% financing, and I don't know. Remember we talked about 100% financing? Just sounds really odd to me because if you have no skin in the game, kind of thing, then you know what I don't know. But you have a loan here.
Well,
tell people about this. What is this now?
Yeah, it's something that I've had for a little while. And when you talk about skin in the game, literally, you don't have upfront skin in the game, but they do. I don't want to just sell the greatest parts about the loan and then tell you, not tell you about the other pieces. The rate's higher. You're looking at around 5% for an FHA loan, which is higher. But you figure that the rates are a lot lower on or usually on an FHA loan. That's one of the benefits. You kind of lose that with this, but it does take care of your down payment. If you're under 115% of the median income, then it's a grant. So basically, as long as you make 36 payments on this thing, so 3 years, that's how they get their money back on that, plus a little bit in the rate. Then it's not a recoverable thing. It's just it goes away and it's paid.
So if I want 100% loan with this, I'm going to get a higher interest rate as a result, correct?
Yes, yeah.
Okay, interesting. Okay,
but it actually those people that did not fit into the USDA, it kind of fit in for them.
Yeah.
We actually went to docs on this one today. So if you make above that threshold, you have to pay it back, and it's either a 10-year loan with no interest for that down payment, or it's a 30-year loan and you just pay like 5% interest. So it's, like I said, it's not for everybody. And if you can get a little gift funds from family or do something, I try to work it out, some other way. But it's a nice option. Well, and the 620 credit score. I mean, if you approve for a FHA loan, you can generally approve for this loan.
Have you had many takers on this?
I didn't push it a bunch because I was a little bit unsure of it, to be honest. But I'm going to docs on my third one. Well, today we got cleared to close, and in the right circumstances, it's actually kind of a nice program.
Well, I'm trying to think of what other 100% loans. The GI, the VA loan is 100% loan.
Yeah, and
USDA is 100% also. But I'm trying. Is there anything else like that has that?
Not really
for just
right
you.
now.
I mean, just for you. So you and I could. Joe and I could actually apply for that type of a loan.
Yes,
there's a few options, but you need to go to see Guido.
Yeah.
On the bad side of town.
Yeah.
No, it's just
anybody can apply. I mean, if I want a luxury home, say for the $500,000 above, can I do that too into this program?
It would still have to fit into the FHA guidelines, and they have the limits at around $281,000. I think it's $281,600 for the FHA.
Or an FHA loan wasn't $474,000.
It was USDA, or was that FHA?
No, FHA is $400.
Now you guys got me all confused.
Yeah.
So your purchase price could be a little bit above that. I think it's around $290 because your down payment's coming out of there, but your actual loan amount has to be that, other than their little funding.
It's just certain amounts that you can't go certain above it then.
Right. So yeah, I mean, it wouldn't really qualify for $1 million property or something like that. It would have to fit into FHA.
Right.
Does that include closing costs when you say 100% or?
No, the closing costs are still something separate.
Yeah. Something separate.
So there is a little piece of this thing where sometimes you can fund some of that in, and I didn't bring that paperwork with me. Just my people have had their closing costs on the 3 that I've closed.
Right.
So I'd have to check before I said something out loud on that.
Well, there's a huge still demand. You look at what's closing, and it's still in that 1 to 200,000 price range to up to 1 to 300,000, right in there, 250, 225, 179. Boy, there's a lot of properties that are closing in that price range in the valley. There's a huge demand for those. So those would qualify for these types of loans and these things.
Well, I'll tell you the 350 to 425 or even 450 category is becoming a thing of the norm right now in the new construction and some of the new products that are coming on.
It's still hard to find properties out there. Anyway, the Real Estate Show got a break coming up. Guy Giles from Bank 34 Mortgage with us today. We'll continue here on the Real Estate Show talking rates, student loans. Lots more to come. Don't you dare go away. We're coming right back to KMED after this. Real Estate Show continues here on KMED. September 23rd is our date. Pete and Joe, the Real Estate Guys, with you, along with Guy Giles from Bank 34 Mortgage with us today. Don't forget, you can check out any of our past shows at realestateShowOregon.com. They're there for you. Some good shows in the past, I'll tell you. And we've had some just really interesting guests with us. I mean, I've really enjoyed so many people that we've learned. The thing is, we all continue to learn some stuff again. Here today, look at Guy today, right? What's that?
I said up until today you learned.
No, I didn't. No, I was just going to say I even learned something from Guy there in that last segment there. Because that to know 100% loans. For everybody, kind of thing, and that
caught my interest a little bit.
Well, it did, and it does. But turn back about credit scores and how this plays into something like this, because people, you see all the TV ads that are out there, and people always talk credit score. This you got to have this, and this if you want a loan. Man. Tell me what's going on.
Yeah,
okay.
I mean, technically on this Genoa fund, you only need a 620 credit score, but if I can do something, or we can do something to help your credit score go up a little bit, you're always going to get a better deal. You don't really want to do a loan at a 620 credit score if you can help it.
You don't. You don't.
There's different breaks. You get up to 640, 660, 680, 720. Just depending on the investor, you're going to get a much better deal. On the government stuff, I mean, it's funny. On this Genoa fund, the rate's just a rate. Pretty much no matter what. But when you're talking about credit scores and things, I mean, I really, you're going to get the best deal if you have a 740 credit score.
740.
But as far as getting a decent deal, 680, 700, you can get a pretty good deal. It's just those guys and gals that are way up there, you get the best one. But there's just so many things that go in. I think one thing that people don't know, or some people don't know, is that all these credit reporting agencies, they're private companies. They're making billions of dollars off of selling your information.
Yes, they are.
And sharing it, unfortunately, on behalf of 143 million Americans.
It's crazy, and I encourage everybody to go through, once a year, do the free credit report, and see what's on there, because there could be things on there that are hurting you that you don't even know. And then you go to buy a car, you go to buy a house, or you do something, and you have this judgment or this lien or something that may or may not even be your debt on there, and it takes time to clean up. They won't answer the phone when you call them. They want you just to dispute everything, and then if you put something in dispute, then you can't get a home loan. So it's better, as you're just starting to think of this, call me. I don't charge anything to sit down with you. We can take a look at your credit and see if there's any boogeymen in the closet we have to deal with.
It really starts there, doesn't it? Yeah. I mean, if you need a loan, you got to have the credit score. You got to have a clean record of something, or no one's going to give you a loan, right? I mean, it's a pretty simple thing about that. If you have bad credit, who's going to give it to you?
And what is there to be hurt by putting it out on the table in front of you and taking a look at it and having a strategized plan to maybe improve that? You can. It could save you thousands of dollars over the term of a 30-year loan. It could be a big game changer in how much you spend for that product.
With prices where they are, it could be tens of thousands of dollars. Yeah. It's pretty crazy, And another thing, I had a person that, and I have a credit union. I deal with a big bank, but I also have a credit union. And this person had an auto loan with their credit union, and it was only reporting to one of the 3 credit agencies. A lot of times that's all they'll do. So you're thinking, oh my gosh, I'm doing this deal and I'm building my credit, and you are to some extent. But it's just good to be able to see your credit report and know, who's getting reported to, what's on there.
How much of the different credit report comes from consumer debt versus, the percentage that how do they get to that score? I've always wondered that,
Yeah, well, it's a little bit of a mystery to everybody, but there's three really, really big ones, and one of them is your payment history. You make your payments on time.
History.
Yeah, that's about 35% of your credit score right there. It's just making your payments on time. Another part is outstanding debt. So you can, if you have a credit card that's, or all your credit cards are maxed out. Yes. That's about 30% of your credit score. So if you can take that down to about 30% utilization or under, so pay some of those down, that'll really help your credit score also.
I've always heard that if you paid a little over the minimum, like even $1 over the minimum, that will help your scores over time too. Is that true?
Yeah, it goes into a smaller category as far as that goes.
Okay.
There's, it starts breaking down. There's three big heavy hitters as far as your credit score. The other one is kind of the length of your credit, and then there's other ones like credit inquiries that are a little bit less. The types of credit that you have, if it's new credit. But really, the big thing, if you can at all do it, is get that utilization down and then make your payments on time.
Make your payments on time. Well, man, that's not rocket science.
Not too much to ask.
Yeah. I can't do that thing, but it's difficult sometimes.
When those payments pile up,
and when your income or whatever or something happens, and it's expensive to be. Man, it really does.
Well, and some of the stuff that you don't even know, like this Equifax thing that came out, just a couple of weeks ago. It is, and I actually called in because I'm thinking maybe it's me too. So they have verbiage like you might have been compromised, and then you can sign up with us, and then we'll monitor. Even though we lost your credit, we'll go ahead and monitor it for you for free for a little while, and then you have to pay us to monitor your own credit. Anyway, it's just a big issue right now, and Elizabeth Warren has actually come out and she's trying to do some reform, and just. I don't know. Just it seems like they have so much control over everything from buying a house. And I don't mean to get weird or negative or whatever, but I like to see some things like this where they're maybe bringing some of this into light.
Checks and balances.
Yeah,
please.
We don't have any control over these private entities that have every piece of information that we've ever had, and it's anyway. Hopefully, more and more people will contact their legislators, and we can get a little bit of traction.
And there's lots of changes. Think about even like the issues of Facebook now. Some of are they a public utility? Regulated by the government the way everybody has it. Everybody's got the things. It'll be interesting. Those are interesting debates to have, huh?
I'd say it's pretty unanimous in the people who are being affected and the people that are left behind in the wake of this breach of security. That Equifax's response has been really poor. Their top executives bailed out in $2 million worth of stock, right? Yeah. In between the time the breach was found to be happened and months later when they reported to us.
All right, and government,
it's just an indication of what can horribly go wrong with all this information in one place.
Well, but you're saying that government's role in this thing is there. That's government's role, just to get this thing under control. Yeah. Well, we'll see if they do it or not. You see a lot of student loan problems right now in trying to qualify people for loans. What's going on with that? Because I've read that. I hear lots of stories about it. What is it?
Well, it's super easy to just throw out the big numbers and then just get kind of bogged down in it. But there is about $145 trillion in student loan debts out there, and the way that the lenders look at it, it's different between all three. Between FHA, between VA, and between conventional, the three big ones. They look at them completely different. And
really,
conventional is actually the one that's the most lenient on it right now. VA is not bad behind them, and the FHA, we're having some people pretty high up at HUD interpret some rules in a bad way. But there's about $620 billion more in student loan debts than there is in credit card debt, believe it or not.
Jeez, I did not know that. Learned that today, too. Okay, wow.
I heard a lady on the Dave Ramsey show the other night. I think that's a competitor one. But anyway, she had over $200,000 in student loans, or just under $200,000. Wow. And she didn't even have she barely had her associate's degree. And they're selling these kids.
They're selling them, and students are crazy even to get into these kind of things.
Is that 1.45 trillion?
Yeah. Yeah.
Okay, is that money that the government actually put out for these loans, or is that a big chunk of that, the interest on these loans?
Huge chunk of it.
Huge chunk. It's not the money they put out there.
Well, but no. The government student loans interest rate is not that bad. It's the private loans where they get really messed up on. Yep. The government student loans, you can get those forgiven. You can get some of that thing. It's the private student loans that I've got one of those, and I'm doing where you get dinged on the interest rate.
Right.
No. So there is a difference.
I bet you far less than that 1.5 trillion has gone out.
Right.
So what is due to come back in, and it cripples these students. It's a tax on education.
And I guess the part of it. Well, and I guess the part of it that's just the hard.
But you got to wait because you got to hold off that thought there. What happens with the student loan debt when you go to get a loan? When you get that, you got that. We'll talk about that when we come back. The Real Estate Show here on KMED. Don't forget, check out any of our past shows at realestateshowOregon.com. We're coming right back here on the 23rd, here September. KMED after this. The Real Estate Show rolls on KMED. September the 23rd is our date. Pete and Joe, the real estate guys, with you here on KMED today. Hope you're having a terrific weekend no matter what you're going to go do. The weather cooperates with us, and I love this time of the year. September, fall,
it's my favorite.
A little cool. That's okay. We'll get some warm weather again, and of course, I hope you have a good weekend, whatever you do. Guy is in the house with us today from Bank 34 Mortgage, and we've been talking interest rates, among other things, today here on the show. And as you said during that, before the break there, student loans and their debts, again, there's so many effects, so many people and potential buyers of homes, that you said that it's the agencies the loaners look at it differently, each one of them.
Yeah, it's vastly different between all three. The FHA, I think one of the big things, and that's kind of where I had it wrong a few minutes ago when you're talking about the government having a little bit lower rates. What I end up seeing is a lot of people in deferment. So the people that are in deferment, they're accumulating interest, and so it's a lot bigger than they initially started out.
Yeah.
So either you pay a smaller amount per month, or you're not paying them at all until you get out of school. And this debt is just growing and growing and growing. So if you can somehow help your kiddos out or direct them to get a degree that'll pay for their student loans or not get into student loan debt at all, I would encourage it.
Well, yeah. And, we give all the money that different groups around the valley give for scholarships. I mean, I can think of our Rotary Club and things like that. But the debt of students is just enormous, and it does come back and affect you later on to buy a home. Correct? It does have an effect.
Absolutely. If the worst case scenario on an FHA is they'll take a 1%. So if you have $100,000 student loan, and this is where HUD is having some trouble interpreting their own guideline. I think they were wrong, but we actually got told the other day that it's the greater of 1% the outstanding balance, or it's what's shown on the credit report, but it's basically whichever one is worse. And if you have a fully amortized payment, that should be the one. But they're actually getting some direction right now, and there's probably a lot of lenders that are interpreting it probably the correct way. But actually, HUD right now is coming out and saying that it's the worst. So if you have $100,000 in student loans, that's $1,000 payment that we have to hit you with.
That you got to account for.
Yeah.
Yeah. And what's the worst? What's the most you've seen in anybody who applied for a home with you with student debt?
Probably about $350,000 between the husband and the wife.
Oh my goodness!
Yeah,
oh,
and
geez.
they were both nurse practitioners, so they at least had a way to dig out of the hole.
But how do you dig out of that hole? How do you dig out of that hole?
You know what? It's just persistence. You just got to make it a priority.
Well, I know we always talk about that, getting out of debt, our own personal debts. People know I've been trying that I'm almost out of there. Years we've been doing that. Talking about Joe's, and you did the same thing. And how many of us? But you never want to get back into debt again, no matter what you do. Oh God, yes, I agree.
And by the way, the FHA or the VA and the conventionals, they are a lot more realistic with their stuff. And I think the VA is just, or the FHA is just a little bit of a mistake right now, but they'll get it straightened out.
But if you're paying a lot on student loans, that's going to really, it can put a crimp in what you're able to afford on a home.
Absolutely.
I mean, that's the difference.
It all goes right into your debt to income ratio. Even if you're not paying on those debts right now, it goes right into your debt to income.
Yeah.
So
I want to ask you about 1031 exchanges, because we had a story here a few weeks ago about in the Congress in Washington, as they talk about tax reform. One of the issues on the table is 1031 exchanges, which kick the tax on your investments down the road. You can keep buying and improving, and then pay the tax down at some point in the future. That would change. That would have a big effect, wouldn't it? Because I know people do 1031 exchanges all the time.
Yeah, I probably only do 4 or 5 a year, but it's definitely a good tool to be able to move your money around.
Yeah.
I mean, it's
as an investment.
Yeah,
an investment.
Yeah, so it's not like you're getting rid of that forever, but it's just one of those things. If the government really needs money, they'll try to figure out a way.
Yeah, they want the money now. Instead of kicking the can down the road, where you will eventually pay a higher tax somewhere in the future.
Yeah, but and one of the things which I would hope is that they don't want to really deter people from buying properties or having investment properties. And I always kind of look at an ulterior motive. And it might be, hey, if we can get some of these people out of these rentals, and other people can buy some more primary residences or something. I always look for the evil something way in the back, but yeah, it's always just about revenue, and I don't know where this one's going to come down.
Yeah, well, no one does. I mean, but it's out there, and these are the things that always the real estate market, which makes it so interesting, is things we talk about is that it changes constantly. I mean, look how the rules have changed for you in the years that you've been with us on our show in terms of lending. There really has been a lot, haven't there?
They've moved a lot, but since I've been doing this show, they've actually got a lot more lenient. They were really
lending
tight.
is more lenient.
Yeah.
But people say in the future, but there's a big difference, is that back then, before the Great Recession, lending was just crazy. But
beyond Wild West.
Today,
yeah.
You say it's more lenient, but you still have to prove you can close, correct?
They are doing it a lot more responsibly now. So it's one of those things that I don't think that we'll have the big correction like we had in the past, because they are doing good lending. They just loosened up on some of the guidelines that probably needed to be loosened up on.
Okay.
And as the affordability index changes, hopefully they won't get too crazy like they did before.
But right now, remember, we are appreciating here roughly 1% a month in Jackson County. So that's so that means if you had $30,000, $300,000 place in a month, it's $3,000 more. So that's what's happening to us here as values rise and demand, supply and demand in this market. And as you say, and I don't see it slowing down. I think the fall is going to be pretty busy.
I don't either. People still want out of California. People still want the climate here, and I think they're going to keep on coming.
Well, they will, and people continue to move up and down in our own market. Mm-hmm. Whether you upsize or downsize, it's happening all around us. And the problem is still, where do you go? I can't believe how many people I talk to about this. Where do I go? And what are my alternatives? And we have such few and limited choices for people. It's really, I think it's pretty sad. I wish it was better.
Yeah.
I wish we had more alternatives.
And that's the thing. It's just, it may not, especially for first-time home buyers, it may not be your dream home, but get into something, get in the game.
Yeah.
My first dream home was a single wide on Butte Falls Highway 30-something years ago. And, it wasn't my last house, but it was some of the best memories, and it's just about getting in there so you don't lose out.
And when you generate wealth, through property here, and the average renter is a small net wealth versus a property owner in this country. So it's
especially
still
at 1%
huge.
per month, a $200,000 house, you've made a little bit of money at the end of the year, and you have a tax deduction that you don't have if you're paying rent.
Makes sense to me.
Me too.
Well, good. Guy Giles, Bank 34 Mortgage. You can check him out. Google him. You'll find him there. He's a terrific lender and will take care of your needs for sure.
Don't forget the home show this weekend. Or not the home show, but
the Tour of Homes continues on.
That's a fun thing.
That'll do it for the Real Estate Show, the 23rd of September for Pete and Joe. Have a great week, everybody. God bless you all. We'll see you back here next Saturday for the Real Estate Show on KMED.
You've been listening to The Real Estate Show on KMED Radio, presented by the Rogue Valley Association of Realtors, along with John L. Scott Real Estate of Southern Oregon and Bank 34 Mortgage. For guest contact information, download our free app, or to watch a past show, visit us online online at realestateshoworegon.com. This show is produced by Table Rock Productions. Join us again next weekend for Southern Oregon's one and only real estate show on KMED. And thank you for making the Real Estate Show part of your weekend.